Start. Welcome today. Thank you very much for taking the time to present at the Red and Black seminar series. For those that don't know Hayden, he's a rate strategist and economist with ANZ Research. He focuses on the Australian economy as well as Australian and US rates markets. There was a bit of activity there last night, as I understand it. Prior to joining ANZ, Hayden worked at the Commonwealth Treasury, where he was primarily involved in forecasting tax revenues and conducting monetary and fiscal policy analysis. So welcome, Hayden, and I'll hand over to you.
Thanks, Stephen, and thanks to everybody for joining us today. So what I wanted to do today was really talk through how we are thinking about the economic outlook, briefly sort of talk through what we've seen so far, but very much focus on how we see things playing out for the Australian economy over the next couple of years. I think the key thing from this seminar from me would really be that in our view, we're very much moving from what was a recovery, a very sharp recovery, just like the sharp fall in through the pandemic. But now we're very much talking about an expansionary phase. So the question now, when I'm out there talking to clients and amongst other market commentators, is how strong this next phase will be for the Australian economy. Our view is that we are about to go into a very strong period of growth, the likes of which we haven't really seen for a number of years. And really there are a few key things that are stopping that. And I'll talk through them, as well as sort of I think anyone talking about the future, particularly an economist, should be honest about what really underpins the thinking. So I'll try and talk through about our critical view, and if we're sort of wrong on that, then it's unlikely we're about to experience the growth that we're forecasting. On the economic and the global sort of space, so one of the things that's, as Australia is a small open economy, it is critical that how the rest of the global environment is playing out. And what these two charts are doing is essentially the left-hand chart is what is a bunch of PMIs. So essentially, they provide an idea of how strong activity is, how many orders are going through around the world in a number of different countries, and putting them together to give essentially a pulse on the strength of goods orders and the like in these economies. And you can essentially see what happened last year. Naturally, you've had a very sharp fall, but it's remarkably strong, the pickup. The pickup in PMIs and the like is very strong. So this is, as you can see, this is across most countries. This isn't, if you look at the colored columns, you can see that this is really all countries. China has come off a touch, but it was essentially leading the recovery in terms of relative to the rest of the world, simply because it was the sort of the country where it went into lockdown earlier and subsequently it sort of came out. A similar story when you look at inventories. Very much the pulse is solid right now, and our broad view for the global economy is strong. What we've, particularly when we think about some of the key nations like China and the United States, very much our view for the United States is they're about to go through a very strong period of growth as well. Critically for them, they've essentially had a paradigm shift in terms of the approach of fiscal policy. President Biden has been willing and able thus far to spend enormous amounts of money in what has typically been a much more conservative fiscal landscape over there. The moment debts started to rise quite rapidly, there was usually pressure for governments to rein that back in. But so far, President Biden has been able to continue pushing his foot, the pedal to the floor on his spending programs. There are risks there. The Republicans, the midterm elections coming up will be key in terms of, a solid showing there for the Democrats is likely to put a stamp on that sort of fiscal policy approach. And that is important. The amount of money that they're spending as a percent of GDP is larger than anywhere else in the world. And a lot of that has come since the end of last year. And that's from once Biden gained office there. And on the flip side, on the other side of that, you've got monetary policy over there as well, still very easy. I think the risks are that you'll start to see some tapering and pullback in monetary policy. But what you're seeing in the labour market there in terms of the recovery from the spending side, everything is very strong. And so we do think that continues on. And so what you're going to see for the global backdrop is a very positive environment, and that's good for Australia. If economies are growing strongly around the world, particularly places like China, inevitably that requires quite a lot of raw resources, which Australia is always happy to provide. So we think that the backdrop is going to be really good for Australia. And in terms of Australia, the Australian economy itself, it really has been simply remarkable that Australian GDP in the March quarter this year had already returned to its pre-pandemic levels, which is really quite remarkable given how quick it's been. The recession was short and sharp, and now the recovery has likewise very much shown a V shape. And so for us, we think the momentum going forward is very strong. And like what I just mentioned before about the United States, the key thing for Australia is very much that they also have, we also in Australia have an RBA who is committed to driving the unemployment rate lower and getting inflation back to target, as well as fiscal policy, where we haven't seen fiscal and monetary policy work in conjunction like this to the levels that we're sort of seeing right now ever before. And that's a pretty important point, which I'll sort of discuss throughout. But just on the RBA, given its importance in sort of setting the interest rate structure you see out there for whether it's for business borrowing, whether it's for borrowing your mortgage and the like, our view is that the RBA is probably going to be keeping the cash rate target at 10 basis points of 0.1% till the second half of 2023. We think in 2023 is when you'll see your first set of hikes. The RBA, with the RBA taking the cash rate to about 0.5% by year end. Now, that's still a long way away, and that's actually a bit earlier than the RBA is saying. The RBA at the moment is still sticking with, they think it's unlikely they'll raise rates before 2024. We think the pulse of the economy will simply be too strong, and so that they will be raising rates. Critically though, we're talking about a period of, the cash rate sitting at 10 basis points, as we're already back at 2019 levels in terms of the broader economy. And so this will be very conducive. It will provide the right environment for businesses to invest and for households to spend. So the RBA is going to be doing its part in trying to achieve higher inflation once again. It wants inflation back in the 2 to 3% target band. That will take some time. We think it's going to take less time than the RBA currently does, but that we'll have to wait and see how that plays out. But the monetary policy will be doing its thing, and then on the other side, and to be honest, this is probably in a way what really makes this time different potentially for the Australian economy is that fiscal policy is remaining incredibly aggressive. So you can see here, this is showing just how payments and revenues as a share of GDP are sort of tracking at the moment. And you can see what happened last year. Obviously, it skyrocketed as the government committed to spending a lot. But what's so incredible really to us is that at the budget this year, it really didn't revise down its expenditure across most of the years. As a share of GDP, the government is still going to be spending at very elevated levels compared to what it has throughout history over the last 30 years. And importantly, and this is, this is a key thing for our thinking, is they're injecting, essentially about 1% of GDP, an additional 1% of GDP every year over the next 4 years, at a time where the economy is already essentially back to where it was. So, a way to think about how incredibly stimulatory monetary and fiscal policy is if you went back to 2019 and you said the RBA is about to do this and the Commonwealth government will do this, what do you think is going to happen to the economy? That's probably one way to think about how positive the outlook is because of these two things working in conjunction together. So the other thing, there are so many positive signs. It's actually, it's almost a challenge to find any sort of weaknesses that we're sort of seeing out there in the economy right now. One aspect that also will help smooth any bumpiness in whether it's the labour market and the like over the next sort of year or so, as we try and get the vaccine rolled out, is households are sitting on enormous amounts of cash. You can see what happened last year. A lot of this has come from injections from fiscal stimulus. A lot of cash flowed through to households, and critically, households haven't been able to spend the way they normally do. In a typical year prior to the pandemic, Australian tourists would typically outspend foreign tourists here in Australia by the sum of about $25 billion. That $25 billion has to go somewhere. Some of it probably went to buying more goods. We saw incredibly strong retail numbers last year, and even so far this year, it's still elevated. But another part is, a lot of it we think has just been put in offset accounts, but essentially it means that households are sitting on enormous amounts of cash. And that just means as the economy opens up and as the vaccine rollout here in Australia hopefully progresses at a solid rate over the next 12 months, that households will likely spend some of this down. That's sort of what we saw after the financial crisis. As you can see in the chart, as household balance sheets rose quite rapidly, households typically then spend it down. They don't just permanently move to a higher level of savings. So this is very positive for consumption. The other thing that is happening at the moment is very much the commodity super cycle. Commodities are simply booming, and of course that's great for Australia. We're one of the largest suppliers of iron ore and coal and LNG. For LNG we are, for iron ore we are in the world. And so this is a very positive story, the boom in prices for income flow into Australia. It's a lot of money, additional money flowing back into Australia as a result of the commodity price boom that we're seeing. This is sort of like what we saw in the years prior to the GFC and sort of post the GFC environment where mining companies had built up their production, and you start to see a large amount of inflows into Australia. All of this helps spending nationwide. In terms of how businesses are feeling themselves, the chart says it all. We haven't seen businesses this confident, really ever. They're reporting that conditions are terrific. They're feeling very confident about the outlook, and this is quite remarkable given we still have COVID, very much impacting a number of countries still. And as we're seeing in Sydney right now, and we just saw in Melbourne, Australia still has to deal with the uncertainties of how things could evolve, and nevertheless, businesses are still feeling this confidence. Just a testament of how good conditions are and how monetary and fiscal policy are supporting the environment. The other key thing in Australia, you can never go anywhere without talking about house prices. And to be fair, it makes sense because we, compared to other countries, have such a disproportionate amount of our wealth tied up in housing. And so the housing market has been nothing short of remarkable over the last sort of 12 months. You had like a slight drop in prices. And then as you can see in this chart, when you look at dwelling prices, they've really just started to surge again. And when you look at housing finance approvals, so essentially once an individual has an approval for debt, it comes up in these numbers. They've absolutely surged, and the historical relationship as a lead for prices is pretty good, but it's suggesting prices are going to get closer to 20% over the next 4 months. We think 2021 will have price growth of about 17% thereabouts. So, you know, the signs are very positive there. One of the key things, what we think has driven this has just been the collapse of funding, the cost of a home. Interest rates, as you know, have collapsed. And critically, one of the important things was the term funding facility the Reserve Bank implemented last year. That gave banks and the like access to very cheap 3-year fixed debt. And that's essentially what, you know, when you look at the mortgage market, why a fixed rate's fallen so much more than variable, it's because of that term funding facility, which was offering banks this very cheap funding that then has been passed through to the housing market. That funding facility expires at the end of this month. So, you know, as you would have seen as well, fixed rates have started to push up. We think they'll probably push up some more, but nevertheless, they're still going to be remaining very low. So the housing market is likely to continue to grow very strongly this year. We think what will actually happen and why housing the growth in prices will slow, not fall, just slow next year, is because late this year we think macroprudential policy will be implemented to slow down housing, the housing market. You know, we've seen quite a bit of commentary from the RBA and APRA about their monitoring credit growth and the like in the housing market. We think it's just going to be too strong, and they'll start to implement controls. Probably things like debt to income ratios, loan to value ratios, and the like. And that will essentially start to slow that housing market down. We think that will come later this year. In terms of one of the things that a strong housing market, of course, means is very strong construction, and the construction sector is booming. Home builder has obviously helped a lot with that. But when that construction sector is going well, and when housing prices are very strong and growing strongly, that's a very strong positive for the Australian economy. There's the construction, but the wealth effect from greater housing, given we have so much wealth tied up in it, always helps with strong consumption. It's very hard to find a period in Australia where you've had, you know, very strong consumption, yet a weak housing market. The one thing I'll just flag about the housing market is that there is one factor that we think will also add to the slowing in the housing market. And it's hard to say how much. We think the cost of borrowing sort of dominate this, and that is population growth. Obviously, with the borders closed, Australia has essentially been growing through net migration. And, you know, you can see in all of these charts which just show you, and if you look in the bottom left, some states like Victoria and New South Wales have been absolutely smashed by the closing of borders in terms of population growth. But I think that this is a constraint on housing. But if we look at what's happened over the last 12 months, where this has already played out and interest rate costs have absolutely plummeted, it's clearly interest rate, the funding side of this is very much so far has been the dominant factor there. And so that's why our view is that even after macroprudential policies implemented, house prices will still keep growing, simply because we're going to be in this very low rate environment over the next couple of years. The one other thing is on the commercial, the non-resi side. Look, that's obviously a bit more challenging for reasons to do with the change in how people work now. It's hard to say for sure how permanent some changes will be, but from the looks of it, it certainly would appear that some sort of flexibility is here to stay. What all these charts are showing you is essentially how occupancy rates in some of the CBDs are tracking, and office vacancy rates as well. Naturally, it's sort of gone the way you would expect. You know, with everyone working from home and the like, ultimately there's less demand for sort of commercial space. And the question really is, well, what's permanent? You know, are the sort of levels we're seeing now at sort of 70% or thereabouts of office occupancies in buildings in sort of the CBDs, is that the new normal? I think it's very hard to say. I think most likely employers will be sort of seeing how things progress over the next 12 months and start to make more permanent sort of calls on it. At ANZ, for example, you know, the approach for us has been, you know, we'll move to 3 days in the office and sort of 2 days from home. And from, you know, other people I've spoken to, that sort of seems to be, you know, quite common out there, that approach. And if that becomes the permanent norm, then I think inevitably that will just mean there's less demand for space in the cities. I think that will be clear. And it's just a question of how much that falls over the next sort of period. So in terms of probably one of the critical things that sort of drives our very positive outlook is that we think this cycle, one of the things that will pick up really strongly is underlying business investment. So businesses will actually look to invest and look to expand in a very strong way. So this is just showing you 12-month CapEx intentions from the NAB Business Survey, which provides a pretty decent guide on where actual investment typically goes in the end. At the moment, it's suggesting it's going to be very strong, and that's sort of consistent with the overall picture that businesses are feeling very good. They're very confident about the outlook. This sort of underpins our view that the labour market, that we're going to continuously see large falls in the unemployment rate, and eventually that will translate into higher wages and ultimately inflation. It's really this investment cycle that we think needs to be strong this time around if we're about to move into a period of stronger than sort of normal growth. Leading up to the pandemic, business investment was really the thing that was missing. And that sort of needs to be different this cycle if we're going to see you know, much stronger growth, higher wages, and ultimately higher inflation as well. The unemployment rate, so just before, this has been a very short, sharp sort of recession. This chart is just showing you how the unemployment rate sort of decline or rise rather, and then decline has progressed relative to previous recessions in Australia. The COVID one is essentially incredibly fast. And as of 11:30 today, if this chart was updated, that blue line would be through the zero axis. We went down to 5.1% in May, an unemployment rate of 5.1%, which is just simply incredible. That was much better than the market was expecting, and so that sort of idea that there's demand out there for labour, that firms are now looking to hire, they're thinking about expanding, looks to be playing out quite strongly. This is, you know, when thinking about the unemployment rate in this chart, well, this indicator looks like it's playing out very accurately given the 5.1% fall in the unemployment rate. But this is showing you capacity utilization that's derived from the NAB Business Survey. Essentially gives you an idea of, you know, essentially how close to capacity businesses are. All the indicators are showing you something like this, that labour demand is very strong. And ultimately, we think that is going to drive this wages cycle. Businesses will start having to compete more on the wage front to attract workers. We're hearing that quite a bit out there at the moment. And so, you know, all the indicators we look at are suggesting that the unemployment rate will keep falling and fall very quickly. So what we're thinking for the unemployment rate is, if you look at the yellow dotted line there, that's our latest thinking. We think we're going to continuously fall. We'll get down to 4.8% by the end of this year. That already looks like it's probably too conservative based off what we saw today. And then it will continue to track lower, you know, getting down to the low fours over the next couple of years. That's stronger than the RBA is thinking, as well as Treasury, which we think were way too conservative in their numbers. As you can see in their forecast now, we think that was too conservative. But nevertheless, this very positive story for the labour market looks to be playing out. And that's ultimately going to drive the wage growth that we'll need to see if you're going to start to see stronger consumption, stronger GDP growth. This chart is just showing you labour underutilization. It's showing you that essentially that relationship isn't broken. So labour underutilization is essentially underemployment plus unemployment. And so it tries to give you an idea of the total labour slack in the market. And you can see it essentially moves quite well with wages growth. So we've inverted the axes there. So as it's getting lower, you should see more tightness in the labour market and higher wage growth. If this was updated for today's data, you'd see that blue line drop even further, quite a bit further, below 14% there. So all the signs are sort of moving in that direction. And critically, for the Reserve Bank, if you want to be thinking about where's the cash rate going, they've been very clear that it's about getting wages sufficiently high so that inflation gets sustainably back to the 2 to 3% target band, something they haven't achieved since essentially the end of 2015. So this is why they're going to be slow to raise the cash rate. They're going to really want to make sure they get it back. But we think that we're now in an environment where you are going to see that type of growth consistent with the RBA eventually raising the cash rate. It'll actually be the first cash rate hike for, gosh, it was in 2010-11 the last time they raised the cash rates. It's been a decade essentially since the RBA last raised the cash rate. In terms of, is this a shock? Well, look, what this chart is showing you is essentially market pricing for the cash rate. So the one year Aussie dollar OI essentially says what's the market pricing the cash rate to average in a year's time for a year, and so on for 2 year, 1 year, and so forth. So for example, the 2 year, 1 year is currently, you can think of that as roughly sort of most of the 2023 year. And so the RBA, the market is already pricing in a cash rate of about 75 basis points in 2023. So the market's convinced we're going into this very strong paradigm. And so as this plays out, you'll expect to see these rates just push higher and higher. And I think that's probably it means that the market, most rates out there are starting to already price in a higher cash rate as market expectations increase. So what you'll see is a lot of rates start to just move higher gradually over the next couple of years. Just the last thing I'll touch on really is just on inflation. There's been a lot of focus now, particularly in the United States, given they've had very strong monthly prints. They had a very strong April print, followed by another strong May print, 0.8 and 0.6% in the months. That was really surprisingly strong. I think the key thing, the way we're thinking about inflation right now, and this is how central banks are thinking about it, is that a lot of this is likely to pass through and wash through. The reason we're seeing some of these goods prices surge so dramatically, we haven't seen it in Australia, so it's important to point that out, but say offshore, is prior to the crisis, a lot of firms had developed extremely efficient inventory systems, and all their supply chains were extremely efficient and global. And what that meant was they essentially were just-in-time inventory systems. They didn't need to sort of run up inventory because essentially the supply chains were so efficient and effective that that's how they could operate and never have issues. Then all of a sudden, what happened is we went through a period where all of a sudden all these things like going to restaurants, going traveling got taken away. You can't spend money on that. All you've got is goods. And so this enormous amount of money surged into the goods sector. And this just-in-time inventory system essentially got overpowered and overwhelmed. And now all of a sudden, a lot of firms are looking to sort of adjust from, we'll just keep essentially the bare minimum, to we want to start stockpiling because we ran out and there's all this demand and we can't fill it. And so that's what we think we're seeing in a lot of these countries right now. In Australia, at the moment, you are starting to see some supply chain issues, particularly in some things like retail trade, manufacturing and the like. Wholesale trade as well, there's been quite a bit. But at the moment, it's not completely universal in Australia. And we haven't yet seen any of that pass through into sort of producer prices or consumer prices here. Our view is that this will wash through as the vaccines fully roll out around the world and borders start to reopen. But we have to, recognize, and we certainly recognize that there are risks to inflation right now to the upside. If anything, most of the risks are really to the upside right now in terms of a stronger outlook than we're currently expecting. And so overall, just to tie it together, I think it's clear that we're really quite confident about the outlook. There are still a number of risks to this. One is that our vaccine rollout runs into issues and all of a sudden we find ourselves behind the curve. Businesses start to worry and all of a sudden this whole investment story comes under pressure. The other thing is there's a lot of focus on what has the closure of borders meant and will mean for wages growth. Obviously, with the borders closed, it means that a lot of, we can't tap into that global labor supply. And so all of a sudden, we're running into issues where labor demand can skyrocket and labor supply can be a bit slower to respond. And so if borders, open sooner than we expect, we think they'll probably open in the second half of next year. There could be some downward pressure on wages, but we don't think it will sort of derail the whole wages narrative. I think labour demand will be that strong from businesses that they'll eventually start having to compete on the wages front, something they really haven't had to do for some time now. And on that note, I might open it up and see if there are any questions. Happy to answer any questions you might have.
Yeah, thanks, Hayden. If anyone wants to ask questions, there's a Q&A function at the bottom of your screen. So please feel free to type your questions in there and we'll try and get them answered for you. I haven't seen not too many there at this stage. I do have a question for you, Hayden. Last night, as I understand it, in the US, the Reserve over there suggested that they were going to start to push or pull back on quantitative easing. What impact do you think that might have on the markets?
Look, it's the tapering question is an important one. Markets have gotten used to having such a large buyer out there with the Fed. I mean, it's been buying 120 billion a month, for essentially a year now. So that's sort of the big question. The reason is not necessarily because you're taking a massive buyer out of the market, but it's also a signal that the Fed now thinks that the economy is strong enough to sort of walk on its own 2 feet. And really it will be taken as a signal that cash rates moves could be on the horizon sooner than previously people had been expected. Certainly the big move overnight really was the Fed's dot plot, which shows the FOMC's expectations of cash rate hikes and the path of the cash rate. And all of a sudden we had 2 cash rate hikes essentially in 2023 in the dot plot. So all of a sudden it does look like overnight the Fed has become more upbeat and certainly more hawkish there. And so when the Fed does start to taper, there is likely to be some dysfunction and volatility in markets. But I think the key thing is they're going to be tapering at a time where the economy over there is very strong. And so don't really see it being a huge issue for markets. And it's unlikely we're going to see some sort of taper tantrum like we did back in 2013.
Good, thank you. I've got a couple of questions that have been asked. Andrew McClellan, is inflation taking off a real risk in the next 2 to 3 years? And if so, what would be the likely RBA response?
Yeah, so I think when we talk about taking off, I think, you know, it's useful to probably put some idea of what I would be thinking when I'm saying inflation's taking off. I would think of inflation taking off if all of a sudden, you know, annual inflation was above or rapidly moving towards the target band. Say we're already at 2% by, you know, the early part of next year. I would say it's really taking off. I think there is a risk that inflation does rise much faster or faster than we currently expect. We're quite relative to the rest of the market, we're quite aggressive, thinking inflation will be back at 2% by September next year. I think if it does start to rise, I don't think, this is the thing about the Reserve Bank now, is previously it used to start to think about adjusting and communicating it might adjust based on its forecast for inflation. So if inflation was rapidly rising, you know, it grew 0.6% in a quarter later this year, they might start to signal cash rate hikes on the horizon. This time, the RBA won't be too concerned. They'll actually, to be honest, they'll be quite happy to see inflation rising, and they'll just let it rise until it's sitting in that 2 to 3% target band, and they'll want to see it there. I think the real question then becomes, what happens if it just goes beyond 3%? What happens if now it's really getting away? I think then you'll see the RBA do what, you know, they've done in the past, for example, prior to the GFC, and that is they'll start hiking, and they'll hike aggressively if they think they need to try and keep it, you know, get it back down to that target band. In terms of, do I think that's likely? I think it's unlikely we're going to get runaway inflation, simply because I don't think the goods inflation we're seeing is going to be permanent. I think that will wash through over the next few quarters as more money moves towards services. So if I was to be looking for signs that there could be a risk of runaway inflation, I'd be watching services inflation over the next sort of few quarters in any country really, that like the US, that's opening up and whatnot, to get a feel.
Right, thank you. The next question is, what impact do you believe the current timber shortage in the construction industry in Australia will have? That's an interesting question. We've seen a few of that in a couple of jobs that we've received recently.
Yeah, I think the timber shortage is one of those things. I think the housing markets everywhere have been booming off the back of what's universal is, of course, the cost of funding these houses has completely dropped. I think we're starting to see the impacts. I mean, for example, in the construction, new dwelling construction component of the CPI, which will be picking up timber shortages through there, it actually rose 2% in the quarter in March, which that is incredibly strong. But because of things like Home Builder and other state grants, the overall price effect was negative. So I think this is a real risk for inflation, is how the housing market plays out. The Home Builder package will continually to suppress prices over the next sort of 12 months as it gets paid out, but the effect will wane. So far, we're starting to see timber prices start to come off the boom that we saw over the last sort of few months. I think that's an indication that we're starting to see demands come off. So we might be past the sort of peak in pricing, and that might be a sign that actually this sort of squeeze is ending. But I think the timber shortage and more broadly the strength in the construction of homes in Australia is going to be quite inflationary for a number of quarters. And I think it's an upside risk to inflation, and one that we're certainly watching very closely.
Okay. Thanks, Hayden. If there's no other questions, thank you very much, Hayden, for sharing your knowledge on this with us today. Thank you, everybody, for attending. Remember that keep your eye out for future webinars that we'll hold. We hold them generally every 3 weeks. And thank you very much, and have a good rest of your day. And thanks again, Hayden. We appreciate it.
Thanks, everyone. Thanks for joining.